Hi, my name's Charlie Aitken of investmentmatters.club. The clock has stopped ticking for Carillion plc, the UK's largest construction company, as it's filed for compulsory liquidation after failing to shore up finances to service its debt, put at somewhere between 1.5 and 2 billion sterling. It's a huge company employing 43,000 people worldwide, almost 20,000 of them in the UK, with thousands more at risk through the contractors that the company works with. The purpose of this short overview is to show that Carillion should not have been a shock, and that the warnings were there as far back as late 2015, not in mid 2017 when the first of the three profit warnings transpired. Also, it's to restate that there are far wider global implications from this story, and these are coming to somewhere very close to you soon. As the blame game analysis starts, the experts are unified in being dumbfounded about how quickly this has happened, with most pointing to the first profit warning of mid 2017, as highlighted on this Bloomberg report. If we actually look at the total assets of Carillion, which is the amber bars, against the total liabilities, the situation doesn't look too bad until you dig a bit deeper and realise that a good third of the asset base is actually goodwill, and goodwill can be switched off like a light switch. Another concern had been the growing unfunded pension liability, that's the yellow bars, put at somewhere in the region of £500 million for Carillion. And this is a problem not just for Carillion, but also for a growing part of the private and public sector within both the UK and most of the Western world. If you look up the definition of Carillion, it's defined as a set of stationary bells hung in a tower. Well, to this chart is looking at a share price of Carillion in 2015. There was a very loud warning bell in October of that year when the red line on this chart crossed below the blue line, which in technical analysis parlance is a 50-day moving average, moving below the longer term 200-day, known as a death cross. No accident that it's given that name, because the share price tends to fall away quite quickly once that transpires. And if we fast forward to today, then we can see there that the share price had indeed fallen by a full 50% from October 15 through to July of 2017, when most of the experts were saying the problem started. Incidentally, if you're wondering what those green and pink bars are, they're proprietary indicators that we use within our investment timing service, which you can find if you look online. I think there's a video on there explaining it. And at its simplest, it's a traffic light system where when it's green, then fine, you should be holding a particular share or index, whatever it is that we're tracking. But if it turns to white, then it means it's a period of caution. And certainly if it then turns into pink, then it means that this should be a share that you're avoiding. And which brings us neatly into a second proprietary indicator that we use, which is nominal versus real. Now, it may look a little bit complicated, but at its simplest, the black line is nominal, which is what you see and what we've been looking at, which is the share price of Carillion in this case, that has fallen from best part of £5 per share all the way down to 14 pence when it's entered liquidation, against the red line, left-hand scale, which is the real price. And the easiest way of explaining that is it's like looking at the share price of the company with the debt removed. And as we can see in this situation, the two more or less moved in tandem up and down from when the share price was first floated back in the late 1990s through to 2007, on the lead up to the 2007 financial crisis, when they parted company. And the red one has continued to head south, whereas the nominal price, the black line, continued to go sideways until it fell off a cliff and started closing the gap between nominal and real. And this is very useful because we use this for, well, just about anything that we look at. And what we're finding is that this is not just a Carillion problem, but it's global in nature. With an example being here, which is the black line being a global stock index courtesy of Morgan Stanley. In other words, if you owned every quoted stock in the world. And as you can see, that's continued on its merry way, whereas real, looking at the Morgan Stanley World Index, in other words, if we're stripping out the debt, peaked way back in the late 1990s and has fallen substantially since then. And there's that yawning gap between the two. And our prediction here is that the black line will indeed fall quite heavily down towards that red line. Okay, so now one final chart before we wrap this up, and it's on the subject of interest rates, and we mean global interest rates, albeit that this chart talks about probably the safest debt on the planet, or what's perceived to be, and that's loans to the US government. And although it's still black versus red, this isn't nominal versus real. If we look at the red line first, this is the interest rate charged to the US government for borrowing money for 30 years. And on the top left-hand side, you can see it was around about 16% back in 1980. And then the cost has fallen all the way down through this 35-year period until it bottomed about 18 months ago in the middle of 2016 at around about 2 point something percent. Now, that's great if you're invested into what's known as treasury bonds, and that would be the black line, because as the interest rate comes down, the face value of the bond goes up to the top right-hand side, as you can see. And but then, if interest rates reverse and start to move up, then the capital value of that bond does the opposite and it falls. And in this example, we expect the interest rate, the red line, to go up a lot faster and a lot further than what most people are anticipating. And vice versa, the black line will therefore fall a lot further and a lot quicker than most people are expecting. Now, we've got lots of coverage on our site under the knowledge share section, so I won't repeat it here. Just drop by and have a look at that in slow time, and you'll start to get an idea of what we're talking about. But this was central to Carillion because apart from share investors being wiped out through their demise, also bond investors where the company borrowed on what's known as corporate bonds will also be cleaned out. So there's going to be endless hype and reasoning about just why Carillion collapsed. Was it iffy accounting? Was it bad auditing? Was it that they overstretched through poor management? And in some ways it's irrelevant because charts don't lie. They are what they are. They're a factual history of the past and a peek to the future, which is why I love them. On a wider scale, reckless policies and an extreme in collective social mood have created a debt mountain, the likes of which we've not seen in centuries. Real and nominal concerns are evident across most asset classes globally, whether it's stock markets, housing, or indeed bonds because of the interest rate cycle. And they are all beyond the control of central banks and policymakers, no matter what it is that they try and tell you. And if it was within their control, then you wouldn't see the 2007 financial crisis, and you wouldn't have seen the the bankruptcy of or the liquidation of Carillion. Anyway, you don't have to be on your own on this, and I'm not trying to be alarmist, but if you've enjoyed this overview and it's made some sense, if you wish to be kept informed, then just drop by the website, leave your contact details, and then you will automatically be updated on interesting topics as they emerge. Thank you very much for your time. Goodbye.